bank bailout is on its way finally. ET now learns that the Modi government has drawn up plans to infuse another 25,000 crore rupees as fresh capital into state-owned public sector banks, which are fighting the twin battle of rising bad loans and slow credit offtake. This amount is over and above the 10,000 crore rupee bailout package announced in the budget. Remember, the government has been working hard to revive the public sector banks through a series of reform measures, including the new bankruptcy code as well.
While no one is disputing the move to strengthen the banking system, the recap plan raises some obvious questions. Should taxpayers' money be used to bail out banks which have done little to clean up their act? Won't 25,000 crore rupees look like a drop in the ocean at a time when banks have amassed bad loans worth lakhs of crores of rupees? The big bank bailout, the pros and cons of such a move. That's our second debate on the India Development Debate tonight. Joining us on the show this evening, Dr. Somakanti Ghosh, making his debut on the India Development Debate. We've also got Professor T.T. Ram Mohan from the Indian Institute of Management, Ahmedabad, and Maithili Busturmat, our consulting editor, joining us as always with her perspective on the India Development Debate. Dr. S.K. Ghosh, I'm going to start off with you. We learned from top government sources that the government proposes to infuse another 25,000 crore rupees to recapitalize public sector banks. This is, of course, in addition to what was committed to in the budget. What's your own sense? Will this recap solve the problem? Is it too little money to make any meaningful difference? What is your view?
See, I agree with your views and also disagree a little bit. I think 25,000 crores on the hindsight is not a big amount. But if you go by the historical experience, I think recapitalization in the Indian context has been often been seen and equated with a bailout. But if you actually look into the data across countries, in India, if you look into this hard data over a 7-year period, I think the total amount of capital injected into India's banks is around 17 US billion. And for China, the figure is 127 billion for 3 years. And for US, 2 trillion. And for Spain, it's around 50 billion. So always the recapitalization of the public sector banks or for any other banks in India has been on the lower side. So that's point number one. Regarding the second point, whether the amount is sufficient or not, I think the amount, it's anything to start with will be better, because right now the banking sector is in dire needs of capital, and you need to understand that there are evidences that once you provide capital to the banks, they tend to clean up their balance sheet and start lending. And as of now, I think lending in India is a problem. Of course, there is a demand issue attached to it, but I believe that to the extent that it can support also the growth capital of these banks, that could be a very good beginning to start with.
Okay, that indeed could be a good beginning to start with. But Maithili, let me throw this to you. This isn't the first bailout of sorts that will happen. Dr. Ghosh is right in pointing out that perhaps 25,000 crore rupees is not big amount, especially when compared to the countries that he mentioned. But how often can a bailout be done? I mean, if you look at the numbers, the top 12 banks in India account for 75.7% of the NPAs. 11 of those 12 banks are public sector banks. There's lone private sector lender, which is ICICI. How long can we do this? At what frequency? And can we lose sight of the fact that it's PSU banks that are creating the mess out there?
Well, Supriya, it is a fact that it's one of the tragedies or features of modern capitalist system and modern banking systems that periodic bank rescues are inevitable in almost all societies across the world. In fact, there are numerous IMF research papers which tell you that countries across the board have periodically had to come to rescue their banks, and this is true not only of India, but in fact in a much larger way of other countries. The US, after the global financial crisis, spent close to 5% of its GDP. The average rescue package across the world has been in the range of 15% of GDP. So by that criterion, what India has spent on recapitalizing its banks, as Somakanti has mentioned, is very low. It's little over 1%. And this 25,000 that the government is thinking of spending right now is neither here nor there, because unless you clean up the bank balance sheets and recapitalize them entirely, you are not going to have banks lending again. So to get banks lending again, this recapitalization has to be part of a larger package, which includes improving the governance of these banks. And then you will find supply of credit being available. Of course, as Soumya mentioned, demand will still be an issue, but unless you recapitalize banks entirely, you will not find the problem getting addressed at all.
Coming on that, Professor T.T. Rammohan, you have Somakanti Ghosh there making a point that, it's not too big an amount, but it will make somewhat of a difference. Something's better than nothing. Maitri believes it's neither here nor there. You need to look at more structural reforms. What's your own view, Professor Rammohan, on this new recap amount that the government is considering to infuse into public sector banks?
Yes, I think the budgetary commitment for this year has been 20,000 crore, and so if you are adding 25,000 crores to that, that's a total of 45,000 crore this year. Now that's not a bad number at all, because my own estimate and the estimate of several investment banks is that we need about 100,000 crores by way of government equity over the next couple of years, which would be about 50,000 crores this year and 50,000 crores in the next year. So, the total figure, if it's going to be 45,000 crores this year with the additional infusion of 25,000 crores, I think it's going to be extremely helpful. And as my colleagues on the panel have pointed out, by any reasonable international standard, I mean, since we keep talking about taxpayer bailouts and so on, you have to understand one thing about banking system, is that banking systems everywhere are a burden on the exchequer and the taxpayer. It doesn't matter whether it's a private sector banking system, which is the case in the vast majority of economies in the world, or if it's a public sector dominated system as in India or in China. Wherever you have a banking system, you're going to have a fiscal commitment and a burden on the taxpayer every few years. What you need to evaluate, in the Indian context, is what is the amount as a percentage of GDP. And again, as my colleagues have pointed out, it's about the lowest. So if you look at something like a 20-year period, the cost of the government is about 1% of GDP, which is about the lowest cost, I think, to the best of my knowledge, this is about the lowest cost of any bailout or any fiscal support to the banking system worldwide. I mean, the minimum that you see across banking systems is something like 5%, and the average would be something like 10 to 15%. So I think, when you view the whole, when you look at the question of government infusion of capital to bailout, it has to be set in some sort of international context. And you have to understand that it's not just a public sector dominated system which imposes a burden on the government. Banks everywhere tend to fail with astonishing periodicity. I mean, the average is about once in 20 years. Once in 20 years, you will have a banking crisis almost anywhere in the world, and the fiscal cost will be substantially larger than in India. And therefore, this amount is reasonable. And in my view, the extra 25,000 crores, as I said earlier, is going to be extremely helpful.
It will definitely be helpful. Any money that comes to the way of public sector banks will be helpful. But Dr. S.K. Ghosh, this debate can carry on. How will the government find the funds, the resources? Is it going to let the FIS expand? I know you've put out a fascinating report out there that how can the government go ahead and do this without harming the fiscal math so much? You want to put it out for our viewers right here? Dr. Ghosh, that question was for you. Finding the right resources to recapitalize public sector banks.
Yeah. See, I think, Supriya, one way of looking into the thing, and which has been successfully done in India in the past during the from 95 to I think till 2005 was the issue of recapitalization bonds. As you know, that Indian budget had this idea of fertilizer bonds, oil sector bonds, where these recapitalization bonds actually isn't transfer from the banks to the government, and there is and the government takes the ownership. So there is no impact on the fiscal deficit. So that is one way of looking into the thing. In the past, 20,000 crores of recapitalization bonds were issued to the public sector banks at one point in 1995 till 2005, and the idea about this recapitalization bond is that it's not only it doesn't impact the fiscal deficit, and since it's a deal between the government and the public and the particular bank, it doesn't impact the market yields also. Of course, it yields the debt to the GDP ratio, but that's a separate thing. But I think as of now, the government could actually think of doing some sort of a recapitalization bond exercise so that it can take care of the recapitalization of the public sector banks, and at the same time without impacting the fiscal deficit number in a significant manner, because I don't see any other option as of now on the table, because the fiscal is already stressed, and I am not sure how much the government will be willing to go down the fiscal path. So either it could be pure recapitalization bonds whereby no impact on the fiscal deficit will be involved, or it could be a combination of fiscal deficit plus a little bit amount of money which the government can actually push its expenditure.
Right. That's the point that Dr. S.K. Ghosh is putting on the table, and we really want to look at solutions in this program, in this debate. Dr. S.K. Ghosh is making a point of looking at recapitalization bonds, something that the government should consider, he says. We have a lot of ground to cover and 15 minutes left for the debate. So, Maithili, I'm going to move on and ask you about another point, which is what is so sanctimonious about this Basel III norms, where Indian banks are committed to meeting the capital adequacy norms by the end of 2019, that Fitch says that the government will need to double the $3 billion if it plans to pump in order to meet these Basel III norms. There have been instances of other countries taking leave from these Basel III norms. Is it sort of cast in stone? Is there an option at all for us to consider?
Well, yes, they're not entirely cast in stone, because these are basically guidelines. As former Governor Dr. Y.V. Reddy has said, these are basically benchmarks which countries should try and to aspire to reach, but every country has some flexibility, has some leeway, and this is what we should try and explore in terms of definitions of what is an NPA, in terms of some kind of forbearance, in terms in fact of what is the kind of capital adequacy that is required. RBI has traditionally in fact been asking for higher than what even Basel itself has been mandating. So, I think this is some kind of flexibility that we really haven't explored so far, and I think in this particular juncture there is a very strong case. Countries like China have repeatedly exploited this loophole. So, I think this is an area that we could exploit, because we do need to ensure that banks feel sufficiently capitalized and start lending again, because until they start lending, you are not going to find credit offtake happen at all, and they are not going to find investment take off. So, there is both the supply side as well as the demand side. Once you get the supply chugging along, demand will automatically come once sufficient capacity utilization happens. So, it is a little bit of a chicken or egg. So, at least the supply side will be taken care of, and this is a flexibility that we should try and exploit to the best possible extent.
Professor T.T. Ramon, you want to come in on that? Do you believe this? I mean, I understand this is not cast in stone, and countries in the past have taken a leave. In fact, India itself has delayed the implementation of this capital adequacy norms. But do you believe at a time like this, when there is so much of gloom in the economy and we are struggling with the fisc, we perhaps can take leave of the Basel III norms, and it's perhaps going to be understandable by the rest of the world?
Well, I think the Basel III norms and the higher requirement of capital, so-called, still keeps banks at a very high level of leverage or debt. So after the Basel III norms, the leverage ratio in banks would be 33:1. That is, the debt to equity ratio would be 33:1. Can you imagine any firm in the non-financial sector, even thinking of operating at that level? In infrastructure, we look at ratio, debt to equity ratio, something like 5:1. But in manufacturing, we would insist on ratios something like 1.5:1. So you have to understand that what Basel III is introducing is the most modest increase in equity requirements, and it is in the interest of the stability of banks and the banking system as a whole. And that is why the RBI has correctly chosen to be ahead of the curve so far as the capital adequacy requirement is concerned, whereas the Basel III norms ask for only for 10.5% of capital. 10.5% of assets as capital. The RBI has unilaterally chosen to impose a requirement of 11.5%, and I think that's very healthy, because as I said, it makes the banks very stable. And once the banks are perceived by the market as being more stable, the valuation of the bank also goes up, and the cost of borrowings of the bank goes down. So you have to understand that this is not some kind of regulatory imposition. This is something which is very much in the self-interest of banks to improve the capital adequacy ratio. And if you look at some of the best managed banks, say in the private sector, if you look at ICICI Bank or HDFC Bank or some of the other private banks, whereas the capital requirement is around 11.5%, they choose to operate at a capital of 17% or 18%. So that should tell you that higher capital is something which is perceived by many of the bank management, by good bank management, to be in their own interest. So I think we should be very clear about these Basel III norms. Now let me also address this question about recapitalization and the cost of the impact on the fiscal deficit. One of the things which is not, I think, widely criticized. One of the things which is not widely understood is that government borrowing for the purpose of recapitalizing banks doesn't count towards the fiscal deficit as per the IMF and international accounting norms. So you may call it some kind of a accounting fudge, but this is an internationally accepted thing. So if you raise money for recapitalization bonds, if government borrows debt for the purpose of infusing recapitalization bonds, that doesn't increase the fiscal deficit technically speaking. So the rating agencies really can't complain.
Right.
If the government borrows 0.5%,
Right.
0.5 GDP, because
Who's
it's
going to
not going to
convince
push
them?
up the yeah. No, it's not a
Okay.
question of this. This is an internationally accepted norm, but
Right.
not widely publicized. So I
Okay.
think this should be clearly understood.
Okay, fair enough. You made an interesting point there, and we've seen the so-called fiscal jugglery happen several times in the past by several finance ministers. This is another option again that you're putting on the table. Dr. Soumyakanti Ghosh, I want to move to the other point, which is on raising capital. Now, the Indradhanush, program of the government allowed banks, public sector banks, to raise a lot of capital from the market. In fact, out of the 1.8 lakh crore that was required for public sector banks, the government said 1.1 lakh crore can be raised from the markets. Yet we haven't seen enough of that happen. There's no reason, frankly, why the government should own anything over 51% in public sector banks. We've seen some of these issues happen. SBI's QIP a few months back was a roaring success. Why aren't other banks also going to the market and raising money from the market?
No, I think that's a very interesting point which you have asked. As far as you know that our QIP issue was oversubscribed, but here actually lies the problem. Even though it is a fact that there is now not enough demand for capital, so there is an argument that why recapitalize at the first place when there is not much demand for loans. But my argument is that until and unless you recapitalize the weak public sector banks and have some semblance of proper book value ratio to the share prices, it is unlikely that they will be able to go to the market and fetch good returns on their QIP. I think there are examples that where this QIP issues of some of the other banks have actually not got full subscription, and I think one of the reasons is that most of these banks have a lot of bad assets on their portfolio, and that is the reason that the public sector, that is the important reason that why we need to recapitalize the public sector banks, so as to give them some amount of capital to shore up their capital adequacy ratio. So therefore, then they could actually go to the market and then mobilize capital. So it's basically some sort of a cycle which you need to start and nudge the banks going to the market, which at this point of time is sadly absent because of reasons which I just outlined.
Fair point indeed. Maithili, but I'm going to bring to you the argument and maybe present a different phase of this. You look at the top 10 banks of India. What is government's business to hold 82% in the Central Bank of India? Why does the government hold 62% in the State Bank of India? So where is the disconnect? Is the disconnect that even though, in principle, nods have been given to banks to go ahead and raise money from the capital markets, the government wants to exert control. It wants to keep control. I mean, even SEBI's norms on public float are being, violated in so many of these cases. So why is the government stake not coming down to at least the agreed 52%?
Well, absolutely. That's one big puzzle, Supriya. I think perhaps the only reason why that the government has not brought down its stake is that it's hesitant to come to the market and get a price which is not satisfied with. Exactly the same reason why it has not come into the market with many also PSUs which it said it would be disinvesting, if not privatizing, not strategic disinvestment, just a sale. Remember, just till very recently, in fact, the IPO market was booming. Now we're seeing the stock market turning a little bit, but in the past few months the stock market was really on a tear, and that was an ideal opportunity for government to offload its stake in so many PSUs. So I think there's this hesitation to allow the public sector banks to come to the market because you fear that you may not get what is the right price. Now the question is, what is the right price? Is there a right price? The right price is always the price that the market is going to give you at that particular moment of time. So I think this hesitation is what is responsible for the banks not coming to the market, because they're always looking over their shoulder to see, is the government going to be happy with the price that they get? And if they fear that they're not going to get the price which the government will be happy with, then they stay back. And on the sole issue of what TTR talked about, capital adequacy and the importance of capital adequacy, I would agree that is very important for private sector banks, but for public sector banks, capital adequacy is really not remotely as important. Not very long ago, Indian banks' capital was completely eroded. It made no difference whatsoever to either its deposits or to its lending, and subsequently the bank was resuscitated. So, the entire issue of capital adequacy I think is a little overdone. To quote a very famous economist, in fact one of the founders of the London Economist, he said that banking is a basin of trust. If you have trust, then you don't need any capital, and if there is no trust, no amount of capital will suffice. So, this emphasis on capital adequacy is a little misplaced to my mind.
Okay. Fair enough. We could probably have another debate one of these days on the Basel III norms as well. We'll try and simplify it for our viewers as well. But Professor T.T. Raman, I'm going to let you have the last word. And very quickly, 30 seconds, we're running out of time, which is on consolidation, because that's another issue that's being considered actively. Is consolidation going to make things worse, make things better, merging weak banks with strong banks? Is that necessarily a smart thing to do?
Well, I think Professor Raghuram Rajan answered that question very emphatically during his recent visit to India. And I think he expressed himself very strongly against consolidation of banks. And I think the point that he made, which is that you don't try to attempt mergers of strong banks and weak banks at a time where the, banks everywhere are facing a high level of stress. I think that point is extremely valid. Management has its hands full trying to manage stressed assets, trying to get the loan book to grow and so on. And what you don't want to do at this point is to saddle them with, additional managerial problems, which are very formidable when you're talking of, merging with some other banks. So I think it's a most unwise idea. It's an idea which can be explored at some other time, perhaps when the banking system is a little healthier. But I don't think we should be thinking of it at all at the present moment. It's going to make the fate of even the stronger banks much worse than it is now.
Sir, T.T. Ram Mohan, Maithili Busturmat, S.K. Ghosh, thank you so much for joining us on this India development debate and bringing some solutions to the table. That really is our endeavor here at ET Now. Thanks for joining us this Friday evening. Now, the economy can't turn a corner till big lenders are, starve for cash to lend and saddle with bad loans. The government realizes that recapitalization is perhaps non-negotiable, but we at ET Now strongly believe that governance and autonomy of PSU banks has to come hand in hand.
I can't agree with you more there, Sandeep, because PSU banks can't be told who to lend to, who to merge with, when to sell and what to do all the time. Yes, government is the big owner of these PSU banks, but government perhaps needs to realize that banking is done best when it's lent and left to commercial decision makers. That's a fascinating debate here on the big bailout. Thank you very much for keeping your date with the India Development Debate this evening. Up next is Top 10 at 10.